everyone. Welcome to Wealth Redefined. I'm your host, Michael Reynolds, certified financial planner and owner of Elevation Financial. You can find me on the web at elevationfinancial.com. Should I invest in the current hot stock? I don't know. Should you? Let's talk about it today. So at the time of this recording, there is a hot stock right now. Everyone's talking about. I'm not going to name it because next time you hear this or next time it comes up, there'll be a different hot stock. So I'm just going to say the hot stock, whatever time period that is, whatever that means to you. There's always a hot stock. So should I invest in it? Should I invest in the stock that is doing really well, that everyone's talking about, that everyone's interested in? Investing in these big names in the stock market has always been tempting. These big giants of the industry are often household names. They've got a reputation for market dominance, and they can potentially deliver, really good returns, really impressive returns. But jumping on the bandwagon for these big players isn't always a smooth ride. There's lots of risks that come with it that we don't always recognize. The draw of investing in big stocks is their, perceived stability and potential for growth. And, these companies usually hold their top spots because of years of innovation, successful acquisitions, effective management techniques. Their size and their resources make them seem like, really safe bets because they've produced really high returns recently and they just seem like they dominate. And the constant media buzz and the analyst coverage and the stocks that are being named in the news really boosts investor excitement, and that can drive prices up even more. So the side effect of that is even higher prices. So, chasing these stocks can seem attractive, but they do have downsides. These companies aren't immune to market conditions that can cause volatility, that can give them challenges like every other company. Valuations can get inflated. So you want to be sure you really understand the risk and reward factor of investing in the latest big hot stock. So first, let's look at things like historical performance. So if you look at the biggest stocks in history, there's a lot of variety, a lot of variation in what happens. These big industry giants have often delivered really great returns over the long haul, but their performance compared to the broader market has been really inconsistent much of the time. Sometimes the biggest stocks have lagged behind smaller companies, which kind of highlights the need for a more nuanced investment approach. So a good example of this, the dot-com bubble of the late 1990s, back then, tech giants just rose to just astronomical valuations. But then when the bubble burst in 2000, these same stocks took a nosedive and many never regained their previous highs. So it's a good reminder that even the most dominant companies aren't immune to market corrections and are still exposed to similar challenges as any other company. In more recent years, the performance of these big stocks has been varied. So after the global financial crisis, large cap stocks in defensive sectors like consumer staples, healthcare, these outperformed the broader market because investors were seeking stability. But as the bull market gained momentum, smaller companies and those in cyclical sectors began to outpace their larger peers, driven by the economic recovery and a renewed appetite for risk, so to speak. So the ups and downs experienced by stocks during different market cycles are also worth paying attention to. These companies can seem stable, but again, they're not immune to market swings. So economic uncertainty or market stress can lead to really big price swings. We saw that in the 08-09 financial crisis and in the COVID-19 sell-off in early 2020. So let's talk about concentration risk. So one major risk of investing really heavily in the biggest stocks is concentration risk. And this happens when a large part of your investment is tied up in a small number of stocks, a small number of sectors, or a small number of asset classes. So with big stocks, the concentration risk happens when you've got too much of your portfolio allocated to, one or two or a handful of specific stocks. That leaves you really vulnerable to market fluctuations and company-specific risk. So the impact of concentration can be really significant. So, one or two of these players could have market fluctuations or volatility or price changes, and that can bring down your portfolio quite a bit if you're over-concentrated. So diversification is key here. A well-diversified portfolio spreads that risk across a broad range of investments, and that minimizes the impact of any single stock or sector on overall performance. So when you allocate again, these big stocks take up a large portion of your portfolio. You're effectively putting all your eggs in one basket, and that can give you significant losses if those stocks take a hit because your whole portfolio is dependent on that single stock and the performance of that single company. So these big stocks often belong to a limited number of sectors also. So you often see these big stocks in technology, sometimes healthcare, sometimes financial services, and that also concentrates your investments in one particular sector. And so that gives you sector specific risk also, like regulatory changes, tech disruptions, or shifts in consumer preferences. So, for example, the technology sector has driven a lot of the market growth in recent years. You've got a few mega cap stocks that account for a huge portion of gains. But this concentration also makes you vulnerable to the sector's volatility and the potential for sudden corrections, which happens a lot in tech, let's be honest. So, again, to manage that concentration risk, you want to approach big stocks really cautiously and, for the most part, stay well diversified. So, that means spreading your capital across different companies, different sectors, different asset classes, and considering factors like market cap, geographic exposure, and risk return characteristics. So, that really reduces your risk and takes you from all of your eggs in one basket to many different baskets that can help diversify that risk. So it helps avoid resilience, gives you more resilience by helping you avoid reliance on a single stock or sector. Also, you want to rebalance. So if you have a portfolio where you've got one segment of your investments outperforming dramatically, it's a good idea to periodically rebalance so that your portfolio goes back into the balance that you've allocated intentionally, as opposed to letting it just kind of run away with one specific investment or sector outperforming. So let's talk about valuation. So one concern with big stocks is valuation, especially during periods of big market growth. So, as the enthusiasm for these big stocks grow, their stock prices can become disconnected from their underlying fundamentals, which leads to inflated valuations, and that might not be sustainable. So this often driven by fear of missing out, or FOMO for short, and that basically extrapolates past growth into future belief that these companies are immune to challenges faced by smaller firms. And so we basically think, well, these companies outperformed in the past, so they're going to outperform in the future as well. And so I don't want to miss out. So that's not always the case, though. Sometimes these biggest stocks don't outperform in the future. You've already kind of missed the biggest growth you're going to get. You want to look at things like valuation metrics as well, things like price to earnings ratio, price to sales ratio, price to book ratio. These will give you more concrete insight into the how the stock is priced. Is it expensive compared to its peers, or its historical valuation? Is it undervalued? Is it overvalued? So you want to make sure you're not overpaying for growth as a result. So, when investors chase big stocks without regard for valuation, they really expose themselves to significant losses if the growth slows, competition intensifies, or unexpected challenges come up. And so, you want to make sure you look at the valuation, make sure it's properly valued, make sure you're not overpaying for growth, and be mindful of the systematic risk posed by the concentration of market value in these, large companies. So what about survivorship bias? When evaluating the performance of these big stocks, it's essential to consider survivorship bias. This occurs when you focus on the companies that have succeeded and then remain prominent while overlooking those that failed. And so that can give us an overly optimistic view of big stock performance because it doesn't account for the companies that have disappeared or seen their market value significantly diminish over time. We're just looking at the survivors thinking, oh, great, this is, we're getting overconfident because we're looking at these big companies that have survived when many others did not. And so, we want to make sure we consider all companies in the mix of investments, including those that have fallen out of favor or disappeared, to gain a more accurate understanding of these big stock performances. So this view helps us contextualize the success of the current market leaders. It basically tells us that for the vast majority of companies, they don't give you the outsized returns that this one stock might be giving you. And these things are cyclical. So that's a reason to kind of curb that survivorship bias and curb that overconfidence. So what do you do? The answer is boring. The answer is diversify. And you're tired of hearing this because It's boring. It's not sexy. It's not attractive. It's not fun. But diversification is a really effective way to avoid the risks that come with trying to place bets on one big single stock. So you want to mix things like large cap, mid cap, small cap, international, and you want to diversify across different asset classes. You want to diversify across different sectors, technology, healthcare, financial services, consumer discretionary, things like real estate, stocks, bonds, commodities. Each particular asset class has its own set of risk return characteristics and profile. And that helps you diversify across all these different companies, sectors, asset classes, et cetera. So ultimately, you want to make sure that you put most of your investments typically in broad, diversified instruments. So for the most part, most people are going to be really well served by investing primarily in mutual funds and ETFs that spread that investment across multiple stocks, bonds, sectors, asset classes, et cetera. It's boring, but boring becomes very attractive when you've got market crashes and market volatility, and you'll be happy that you weren't concentrated too much into one particular stock. So what do you do if you just can't resist? What do you do if you just can't resist investing in the latest hot stock? So I would try compromising with new money. So a good approach can be, instead of reallocating your existing investments, set up a brokerage account that is just for investing in that trending stock that interests you. So don't change your existing contributions. For example, if you've already got money going to a 401k or a Roth IRA, keep those contributions the same. Don't change anything. But open a new brokerage account, invest additional money into this brokerage account, and invest in that stock. So this works because you're not sacrificing your existing financial plan to chase a hot stock, and you can still scratch the itch and put new money into it. It's also effective because it forces you to be honest with yourself about your priorities. So in order to free up money to invest in the stock, you might need to cut back on other areas of your budget. So you can see how important that really is to you. So, if you're like, hey, I want to invest in, this particular stock that's on fire right now, I just really need to get into it. Again, don't change anything else you're doing. Open a new account. And let's say you want to put $500 a month into this account for this new stock, or you want to just pile up and invest as quickly as much as possible. Well, you're going to have to cut back somewhere else. And so it kind of forces you to really prioritize and say, well, do I want to eat out less this month? Am I going to delay this big purchase? Am I going to slow down on, something else I'm saving up for? Or I'm going to, cancel some subscriptions or other things because it's really important to me to put money in this new stock. I think that's reasonable. I think that's okay. It's not a terrible thing to do that. I wouldn't personally advise it, but if you just really can't resist scratching the itch to invest in this hot stock, that is one way to do it without upending and turning upside down your existing financial plan. So again, don't take this lightly. Don't just jump on the bandwagon and impulsively invest in the hot stock that's in the news, that everyone's talking about. It seems like it's just producing these dramatic returns. Chances are you're going to be introducing a lot of risk into your financial life if you overdo it. And, FOMO does crazy things to us. It wants us, it keeps us from making rational decisions, and it really causes us to be impulsive. So, keep in mind that the most successful investing is based on thoughtful, disciplined, prioritizing long-term value creation over short-term gains. Look beyond the hype. Focus on sound investment fundamentals, steady, reliable, disciplined approach. It's boring, but that's what leads to the best chance of success and building wealth overall. So hope that wasn't too much of a downer, but keep that in mind. I want to make sure that we don't overdo it when impulsively going after these big hot stocks, because it's not always the shiny success story that it might seem. So with that, as always, you're welcome to reach out anytime. My website is elevationfinancial.com. You can send me notes through there. You can find me on social media. Or if you want to consider becoming a client, you're welcome to book a free consultation on my website, and we can chat. Again, that's elevationfinancial.com. Thanks for joining me today. Have a great day. See you next time.